Markets often feel slow, not because nothing is happening, but because decisions are being prepared quietly. Most people expect markets to move when attention is high and news is loud. Reality is usually the opposite, because markets respond to positioning, not noise. When everyone is watching the same level, prices often stop reacting. This pause confuses retail traders who expect instant confirmation. Professional money rarely moves during moments of maximum attention. It waits for moments when emotion fades and impatience grows. This behavior has repeated across stocks, oil, currencies, and even new sectors. The market is not designed to reward anticipation without evidence. It rewards execution after conditions align. When price stays flat, people assume opportunity is gone. In reality, flat price often means pressure is building underneath. Silence in markets usually signals preparation rather than weakness. Large moves require imbalance, not consensus. Consensus creates stability, not direction. This is why crowded trades often disappoint. Everyone sees the same chart, but not everyone understands timing. Depends on psychology more than indicators. When traders feel bored, they stop paying attention. That is when positioning quietly changes. Markets prefer to move when confidence drops. Confidence creates resistance to movement. Doubt creates opportunity for expansion. This pattern appears across different market cycles. It also appears across different asset classes. Oil markets often move after weeks of calm pricing. Currency markets behave similarly during consolidation phases. Stock indices frequently break out after long periods of frustration. Electric vehicle stocks have shown this behavior during global transitions. China and Japan's EV markets paused before major revaluations. Most retail traders entered after the move already started. They reacted to headlines instead of preparation signals. Markets do not reward reaction. They reward patience aligned with structure. Forms when activity slows. Slowness filters emotional traders out. Only committed positioning remains. That is when markets are most vulnerable to expansion. Feels sudden but is rarely random. It is the result of earlier invisible decisions. Those decisions happen when attention shifts elsewhere. This is why watching price alone is not enough. Understanding behavior is more important. Behavior explains why moves feel unexpected. They are unexpected only to those watching too closely. This is the foundation of how markets truly move. In the next part, we will connect this behavior to current market conditions and show how today's environment fits this pattern exactly. Current market conditions reflect this exact phase of quiet preparation. U.S. indices are holding levels without strong follow-through. This behavior frustrates short-term traders. Frustration leads to poor decision-making. Poor decisions transfer money to patient participants. Right now, markets are not collapsing or rallying aggressively. They are absorbing information. Economic data is being processed slowly. Oil prices are fluctuating without clear trend commitment. This tells us positioning is still forming. Dollar strength and weakness are alternating in tight ranges. That usually happens before directional clarity. Bond yields are moving cautiously rather than impulsively. This signals institutional uncertainty, not fear. Uncertainty creates opportunity for those who wait. Retail traders often mistake uncertainty for danger. Professionals see uncertainty as flexibility. Flexibility allows better risk placement. When markets are loud, risk is high. When markets are quiet, risk becomes manageable. This is why experienced traders prefer dull environments. Dull price action reduces emotional pressure. Reduced pressure improves execution quality. Most losses happen during emotional periods. Those periods usually come after long silence. Silence builds tension. Tension eventually releases through movement. Movement feels sudden to observers. It feels planned to participants. Right now, multiple sectors are in this holding pattern. Energy is reacting but not committing fully. Technology is stabilizing after prior momentum. Financials are rotating quietly. These rotations rarely happen during headlines. They happen during boredom. Electric vehicle stocks are another example. They often trade sideways before repricing cycles. Global markets are showing similar restraint. Asia and Europe are not panicking. Global calm supports U.S. consolidation. This alignment across regions matters. Markets rarely move independently. They wait for confirmation across systems. Confirmation requires time. Time tests patience. Patience filters weak positioning. Only conviction remains. That is when expansion becomes possible. In the next part, we will break down how psychology creates mistakes during this phase and why most people exit right before movement begins. Most market mistakes are psychological, not technical. People lose money because they react, not because they lack information. During quiet phases, the brain searches for action. No action feels like missed opportunity. This feeling pushes people to force trades. Forced trades usually happen at bad prices. Bad prices increase stress. Stress leads to exits at the worst moments. This is how patience transfers wealth. Markets are designed to test emotional discipline. Boring periods are intentional filters. They remove impatient participants quietly. Retail traders often confuse movement with opportunity. Professionals look for imbalance, not motion. Imbalance forms before price moves. Right now, imbalance is forming silently. Oil traders feel this frustration clearly. Oil headlines change daily. Price often ignores those headlines. This disconnect confuses new traders. Confusion causes overtrading. Overtrading increases transaction losses. The same pattern appears in the dollar. The dollar moves sideways while narratives change. Narratives exhaust attention. Price waits for positioning to finish. This is why markets move suddenly later. Sudden moves are not sudden decisions. They are delayed reactions. Electric vehicle stocks show this behavior often. They consolidate while news cycles repeat. Then repricing happens without warning. Those watching daily miss preparation phases. Those positioned early feel calm. Calm traders survive volatility. Emotional traders feed volatility. Most people exit during calm periods. They re-enter during excitement. This is the classic retail mistake cycle. History shows this repeatedly, not in one year, but every cycle. Markets reward those who wait through boredom. They punish those who demand entertainment. Entertainment and profitability rarely align. This is why education matters more than prediction. Understanding behavior reduces reaction. Reduced reaction improves consistency. Consistency compounds results. In the next part, we will connect this psychology to real market examples and explain how smart money positions during silence. Smart money never waits for confirmation headlines. It waits for emotional exhaustion. Exhaustion appears when people stop caring. Low interest creates opportunity, forms before price reacts. This is why big moves feel sudden. They are invisible until they are obvious. By the time retail notices, positioning is complete. Dollar markets show this clearly. The dollar stays quiet while pressure builds. Traders misread stability as weakness. Stability is preparation. Preparation always happens quietly. Oil markets follow the same pattern. Prices compress while narratives fight. When compression ends, speed increases. Speed punishes late reactions. Late reactions chase candles. Candles do not offer good entries. They offer emotional decisions. Electric vehicle stocks experienced this recently. Price stalled while news repeated. Then valuation adjusted quickly. Those waiting for excitement entered late. Those watching structure stayed early. Structure matters more than stories. Stories change faster than positioning. Markets move when stories stop working. This is when reality replaces noise. Noise attracts attention. Reality moves capital. Capital movement decides direction. Retail focuses on direction first. Professionals focus on pressure first. Pressure releases create trends. Trends do not start loud. They start ignored. Ignored phases create disbelief. Disbelief creates opportunity. Opportunity disappears when belief returns. The cycle repeats across assets. Stocks, oil, dollar, and crypto all follow it. The asset changes, behavior stays constant. Understanding behavior reduces chasing. Reduced chasing improves timing. Timing improves survival. Survival allows consistency. Consistency builds long-term results. In the next part, we'll break down how traders can recognize this phase early and avoid reacting when nothing seems to be happening. Markets rarely move because everyone agrees. They move when most people misunderstand reality. Quiet price action often hides serious positioning beneath the surface. Many traders assume inactivity simply because headlines slow down. Slow phases are where disciplined money quietly builds exposure. Big capital avoids attention and waits for emotional exhaustion. This is where psychology begins, separating patience from impulse. When prices stop reacting to negative news, internal strength develops. Most people miss this because they are trained to react instantly. Dollar stability during calm markets often signals silent rebalancing. A flat dollar does not mean nothing is happening underneath. Risk assets adjust slowly when pressure is controlled. This creates boredom, which pushes emotional exits. Professional traders treat boredom as confirmation. Retail traders confuse silence with danger and leave early. Energy prices also influence sentiment quietly during these periods. Rising oil without panic reflects managed inflation expectations. Markets respond better to pressure than sudden shocks. Controlled pressure builds structure instead of fear. Structure allows large players to size positions carefully. Retail often mistakes structure for manipulation. This mistake repeats due to impatience. History shows strong trends begin during frustrating periods. Confidence is tested when excitement disappears. Dollar behavior must be read through reaction, not opinion. Assets. Absorbing pressure signal growing confidence. Confidence shows through behavior, not headlines. Psychology matters more than prediction here. Prediction increases stress and reduces clarity. Observation improves decision quality. Markets reward patience over action. Losses usually come from timing errors. Timing improves when patience is respected. This phase is not about aggressive buying or selling. It is about recognizing alignment forming. Late entries increase risk once momentum appears. Dollar balance plus rotation often precedes movement. Ignoring rotation keeps focus on wrong assets. Markets reallocate attention gradually. Understanding this prevents emotional mistakes. Discomfort signals slowing down decisions. Discipline separates professionals from impulse. Markets need alignment, not excitement. Alignment forms quietly through patience. Most people miss this phase entirely. Those who recognize it prepare calmly. This phase protects long-term confidence. Most traders fail not because markets are hard, but because timing is ignored. They enter when stories feel convincing instead of when structure forms. Confidence usually appears late, after risk has already increased. This is where losses quietly begin. Markets reward those who act before excitement arrives. Excitement signals overcrowding, not opportunity. Crowded trades increase volatility and emotional exits. Dollar strength during excitement often signals short-term exhaustion. Many mistake dollar spikes as trend confirmation. Spikes usually reflect short-term positioning pressure. Sustainable moves develop without dramatic headlines. This difference is critical but often overlooked. Psychology shifts faster than price. Price only confirms psychology later. Retail reacts to visible movement. Professionals react to invisible alignment. Alignment forms when reactions weaken. Weak reactions indicate balance returning. Balance attracts larger capital. Larger capital avoids volatility. This explains slow accumulation phases. Most traders dislike slow phases. Discomfort creates impatience. Impatience creates poor timing. Poor timing creates unnecessary losses. History repeats this pattern consistently. The same mistakes appear every cycle. Different assets, same behavior. Dollar behavior reveals this clearly. When dollar movement stops surprising markets, pressure resets. Reset phases allow new positioning. New positioning happens quietly. Silence is intentional during these periods. Noise comes later. Noise attracts late participants. Late participation increases risk. Markets do not reward urgency. They reward preparation. Preparation happens during boring phases. This is where discipline is tested. Psychology decides outcomes more than strategy here. Strong strategies fail without patience. Patience improves execution quality. Execution quality protects capital. Capital protection creates longevity. Longevity beats quick wins. Quick wins create false confidence. False confidence amplifies mistakes. Markets punish arrogance efficiently. Humility improves observation. Observation reveals subtle signals. Subtle signals precede major moves. Ignoring them delays reaction. Delayed reaction reduces reward. This phase is about readiness, not action. Readiness creates advantage. Advantage appears before price moves. Price moves last. Those waiting for price confirmation arrive late. Late arrival increases emotional stress. Stress leads to forced decisions. Forced decisions increase errors. Markets exploit emotional behavior. Understanding this shifts outcomes. This phase teaches restraint. Restraint builds consistency. Consistency outperforms intensity. Most mistakes happen after traders feel confident. Confidence often appears when risk is already high. Markets quietly punish late confidence. Early uncertainty usually offers better opportunity. Dollar reactions reveal this timing gap clearly. When the dollar moves aggressively, risk usually follows. Aggressive moves attract emotional participation. Emotional participation weakens structure. Weak structure fails under pressure. Pressure exposes poor positioning. This is why breakouts often fail. Failure teaches discipline only to observers. Participants feel frustration instead. Frustration leads to revenge trading. Revenge trading accelerates losses. Losses shift focus from logic to emotion. Emotion clouds judgment. Judgment errors increase frequency. Markets exploit frequency. Fewer decisions usually perform better. Weighting reduces error probability. Probability favors patience. Dollar stabilization signals probability improvement. Stable dollar phases allow recalibration. Recalibration resets expectations. Reset phases feel confusing. Confusion keeps crowds inactive. Inactive crowds reduce volatility. Reduced volatility attracts strategic capital. Strategic capital avoids noise. Noise increases during narrative phases. Narratives oversimplify complexity. Complexity requires observation, not action. Most traders avoid complexity. Avoidance delays understanding. Delayed understanding creates misalignment. Misalignment increases drawdowns. Drawdowns break discipline. Discipline separates survivors from quitters. Survivors adjust pace. Quitters increase speed. Speed increases mistakes. Markets slow fast traders down. Slow traders remain aligned. Alignment improves decision clarity. Clarity improves execution. Execution controls outcome. Outcome reinforces behavior. Positive behavior compounds. Negative behavior accelerates decay. Dollar behavior highlights this cycle repeatedly. Every cycle follows similar psychology. Different assets repeat the same story. Those who learn patterns improve consistency. Consistency reduces stress. Reduced stress improves patience. Patience attracts better timing. Better timing improves reward to risk. Reward to risk defines longevity. Longevity defines success. This phase builds longevity, not excitement, not urgency, but structure. Markets often reveal direction before price confirms it. Most people wait for visible movement to feel safe. Safety usually appears after opportunity passes. Early signals feel uncomfortable by nature. Discomfort discourages impulsive behavior. Impulsiveness increases error frequency. Errors compound faster than profits. This is why patience remains undervalued. Dollar movement quietly reflects global confidence. Confidence shifts gradually, not suddenly. Sudden moves usually attract weak positioning. Weak positioning fails under pressure. Pressure exposes emotional decision-making. Emotional reactions distort perception. Perception controls interpretation. Interpretation drives action. Action defines outcome. Outcome reinforces habits. Habits determine long-term results. Markets reward adaptive behavior. Rigid thinking increases vulnerability. Flexibility improves survival. Survival allows learning. Learning improves timing. Timing improves consistency. Consistency reduces stress. Lower stress improves clarity. Clarity strengthens discipline. Discipline sustains performance. Performance compounds over time. Compounding requires stability. Stability grows during calm phases. Calm phases feel boring. Boredom triggers doubt. Doubt pushes premature decisions. Premature decisions reduce edge. Edge depends on alignment. Alignment develops slowly. Slow development discourages crowds. Crowd absence reduces noise. Reduced noise improves signal quality. Signal quality improves confidence. Confidence becomes grounded. Grounded confidence resists panic. Panic destroys structure. Structure supports continuation. Continuation rewards patience. Patience is rarely celebrated. Yet patience wins repeatedly. Markets do not reward urgency. They reward preparation. Preparation happens quietly. Quiet phases shape outcomes. This is one of those phases. Understanding it changes behavior. Behavior shapes results. Results reflect mindset. Mindset determines longevity. Longevity defines success. This is why awareness matters. Markets are not designed to entertain. They are designed to transfer money based on behavior. Those who understand behavior gain advantage. Those who ignore it repeat mistakes. This phase is not about prediction. It is about preparation. Preparation reduces emotional exposure. Reduced emotion improves clarity. Clarity strengthens discipline. Discipline protects capital. Capital protection allows participation. Participation builds experience. Experience refines judgment. Judgment improves timing. Timing defines success. Right now, timing matters more than speed. Speed increases risk during uncertainty. Uncertainty rewards those who wait. Waiting does not mean inactivity. It means observation. Observation reveals patterns. Patterns appear before headlines. Headlines arrive after movement. By then, positioning is crowded. Crowded positioning limits upside. Limited upside increases downside risk. This is why patience remains critical. Dollar behavior continues to guide sentiment. Sentiment shifts quietly. Quiet shifts build structure. Structure supports sustainable moves. Sustainable moves last longer. Longer trends reward disciplined participants. Discipline outperforms excitement. Excitement attracts late entries. Late entries increase volatility. Volatility tests emotions. Emotions distort decisions. Distorted decisions create losses. Losses break confidence. Broken confidence leads to exits. Exits usually happen at the wrong time. Understanding this cycle changes approach. Approach determines outcome. Outcome reflects mindset. Mindset shapes consistency. Consistency builds trust. Trust allows better decisions. Better decisions compound results. Compounding requires time. Time favors patience. Patience separates professionals from crowds. Crowds react. Professionals observe. Observation creates alignment. Alignment creates opportunity. Opportunity appears quietly. Those prepared recognize it. Those chasing miss it. This is why awareness matters. Not excitement, not prediction, but understanding. As markets move forward, stay focused. Let data guide decisions. Let behavior reveal intent. And let patience do the heavy lifting.